Stock markets ebb and flow as investors move their money in and out of the market and in and out of various sectors within the market. Investors are always looking for the most profitable places to put their money, and when they see an opportunity to make a better return on their investment in one market over another, or in one market sector over another, they are willing to move out of the less attractive investment and move into the more attractive investment. Investors are not limited to the stock market when they make their investment decisions. They can invest in bond markets, commodity markets, real estate markets, and more. To make a decision on where to put their money, investors look at the potential return available in any one market and the amount of risk they would be forced to accept to participate in that market. If a market does not offer a potential return equal to the potential risk, investors will avoid that market. Two markets that investors tend to freely move their money back and forth between are the stock market and the bond market. Accurately identifying the market cycles when demand for stocks is increasing and those cycles when demand for bonds is increasing can help you to make profitable stock or ETF trades. When you see demand shifting from bonds to stocks and stocks begin to increase in value, you can profit by doing either of the following. You can buy a stock index ETF that is likely to go up as stocks increase in value, or you can sell bond ETFs that are likely to go down as bonds decrease in value. When you see demand shifting from stocks to bonds and bonds begin to increase in value, you can profit by doing either of the following. Buying bond ETFs that are likely to go up as bonds increase in value, or by selling stock index ETFs that are likely to go down as stocks decrease in value. Investors also tend to move their money from one market segment to another. Price movement within market sectors is driven by the same forces of supply and demand that drive price movement as investors move their money back and forth between the stock and bond markets. Oftentimes, when investors see one sector begin to gain momentum, they will start moving their money into that sector. This increase in demand and inflow of cash typically causes the stocks within popular sectors to gain more momentum. On the flip side, as investors are eagerly moving their money into popular sectors, they are pulling their money out of less popular sectors. This increase of supply and decrease of demand in the less popular sectors typically causes the stocks within those sectors to lose value. Accurately identifying when demand for stocks in some sectors is increasing and demand for stocks in other sectors is decreasing can help you make profitable stock or ETF trades. When you see demand shifting from one sector to another, and the stocks within the popular sector begin to increase in value, and the stocks within the unpopular sector begin to decrease in value, you can profit by doing any of the following. Buying ETFs that cover the sectors that are gaining in popularity, buying individual stocks within the sectors that are gaining in popularity, selling ETFs that cover the sectors that are losing popularity, and selling individual stocks within the sectors that are losing popularity.